It's 3:10, and we're starting just a tad bit late today. But, it's Friday. It's Finance Fridays, and we want to go ahead and get started and invite all of you to make sure that you press share so that other people can enjoy this information that we're going to be able to see today. We're going to finish up what we started last Friday and then go into something deeper this Friday. I think you're going to enjoy. Most people are unaware of the amount of interest that we actually pay, and I'm going to go into a little something that we talk about in the P.I.L.L method, where people with perfect credit often pay between 100 and 300% interest, and they don't even realize it. And so we're going to show you where all that interest is hidden today. But we just need to get the basics down first, okay? We want to make sure that we have the basics, and then once we do the basics, we'll be able to go into much deeper an understanding of how this whole thing comes together and how it is possible to cut your interest cost by 75%. But first of all, let's start here. Okay? So on the screen, you see my new book. It's doing quite well on Amazon, and you really do want to pick that up. The P.I.L.L method, a better way to eliminate debt. A P.I.L.L method, a better way to eliminate debt. And I tell you, it's going quite well. I'm getting the reviews are coming back really good, and people are getting the information that they've never received before on how all of this comes together. So let me put a different picture up here. Let's see here. Where did they go? Let me see here. Let's try this one. Okay, this one you see all the time. Let's go here. All right. So the book is on Amazon right now, and it's on a couple of bestseller lists. It's not quite at number one. It is number one when it comes to new releases in Christian books, but it's not number one overall. So keep purchasing it, keep reviewing it, and pretty soon it will be a number one bestseller, and I'll have all of you to thank for it. All right? So let's pick up where we left off last week. All right, so let me bring up the PowerPoint here. And there we are. So last week, we left off with the power of the penny. The power of the penny. Very powerful information. And I want you to let's start here. So what we talked about last week is applying money to principal at this point. And you want to see episode 1 so that you can understand what's going on in episode 2. So if you're just finding out about episode 2, then go ahead, go back to episode 1 and watch it. But right now, what we're talking about is if we were to apply to the loan that we were talking about, $1.56 to principal, that we could save $9.38 in interest. Going all the way down to 1 penny saves you 7 cents in interest. In other words, if you were to look at buying a $5 cup of coffee, now, we're not saying that you can't buy coffee or you can't enjoy yourself. What we're saying is that make sure that you have a fund budget. And once you have that fund budget in place, once you spend it for the month, it's gone. Because now, when your fund budget is gone, then you're thinking you may be tempted to think that an extra $5 would not hurt. Well, let me tell you. In this situation, if we're just thinking about spending the $5 and not thinking about how much interest that $5 could cancel, that can be a problem. And in this case, $5 eliminates about $35 in interest. So it's not a $5 cup of coffee, it's $5 plus another $35. That's a $40 cup of coffee when you take a look at how much interest could be canceled. So it's very important. I had a call, I might have talked about this last week, but if I didn't, here we go. I had a call from one of my clients in California that says, Don, we are under budget on our food budget this month. So we did really well, and we had $4.69 left. The program, the opportunity cost calculator, said put that money into a savings account. So we did. The program reconfigured everything immediately and then told us we saved an additional $30 in interest. We had no idea. And so they left the money there so that they can actually pick up extra fragments, all right? And so what we want to do is gather the fragments that nothing be lost. And so as we gather up the fragments of money and know how much they're worth, then paying them towards principal at the right time in the right month, applying to the right loan, we maximize the amount of interest that we can actually save per dollar. It's not just throwing money at an amortization schedule or at your loan willy-nilly. It's applying at the right time, in the right month, on the right day of the month, and applying it to the right loan that makes all the difference in the world. So we want to be able to save the maximum amount of interest per dollar so that we don't violate the law of diminishing return. The law of diminishing return talks about there is a point at which more is too much, and and when you don't apply enough, it is too little. So what we want to make sure is that whatever we're applying, it is the right amount at the right time so that you can kill the maximum amount of interest. So we've said it before, and we'll say it again. To get out of debt, all you have to do is pay less interest, get out of debt faster, pay more interest, stay in debt longer. Now we're going to talk about isolating the principal amounts. What does that mean? Figuring out what is that key amount. What is that magic number for each individual? And that magic number is constantly changing because the amount of money that we spend each month changes with the variations in our food budget, or what we pay on the power bill, or we did a lot of driving and our gas budget we paid a little bit more, or we might have saved some money on some other parts of the budget. So that magic number on which we want to put away for later use to apply to principal is constantly changing. So this is why we want to isolate the principal amount so we can come up with the right number. Now, in this case, here we have a $200,000 mortgage at 6%, and we're looking at the cumulative principal for 12 months, 1 year. That's $2,456 and a penny. All right. And so what if we were to take a look at what's really going on here? That is all the principal amounts added up. All the principal amounts added up. So let me ask you, if we know that we're going to if we know that we're going to pay $2,456 and a penny all at one time, eventually, why can't we just say, you know what? If we had it, could we apply it to the loan all at once instead of 12 monthly installments? Why couldn't we just apply it? What would happen if we did? Okay, let's do the math. We're going to take $200,000. We're going to subtract $2,456 and a penny because we're going to apply it all at once. And there we go. It comes to $197,543.99. Isn't that the principal balance on line 12? So are we saying if we apply $2,456 and a penny all at once on line 1, we're paid down to line 12 in 1 month instead of 12 months? That is correct. So what happens then? What happens to all the interest between line 2 and line 12? You got it. It disappears. You never have to pay it. You have nearly $11,000 in interest savings. It is amazing. Take a look at that. Knocks all of that interest out between line 2 and line 12. $11,933.19. Now we have to subtract $1,000 out of that because we have to pay the $1,000 on line 1. Now we have to pay the bank something. I wish we could get out of debt without paying any interest, but to move your loan from point A, which is up here, to point B down here, the bank would love it if you would give them $11,933.19. But with the way that we just explained, you can move from point A to point B for just $1,000 in interest. Isn't that amazing? Has anyone ever pointed that out to you before? So here's another look at isolation. Listen, now I don't recommend this. This is just a thought experiment, all right? A thought experiment. What if you wanted to put $2,456 and a penny on your loan, but you didn't have it? But you found out what you could do if you did have it. So you go next door to your neighbor and say, neighbor, I'd like to borrow $2,456 and a penny, and I'll pay you 10% interest on that money. The neighbor says, oh my goodness, I'm getting less than 1% at the bank. Absolutely. So you borrow the money from the neighbor. So if you borrow that money, which is 10% money now, 10% money, and could you now take that 10% money and apply it to this 6% loan? You most certainly could, but would it be wise to take money that you're paying 10% on and apply it to a loan that is only at 6%? Remember, the answer to all of these questions that we're going to be asking is, let's do the math. Did you do the math? So don't go on feeling. Don't go on what you think should happen. Don't go on what it looks like. Let's do the math. Let's find out for sure. Okay? So in this case, we don't want to focus on interest rate. We want to focus on interest cost. Don't let the interest rate fool you, because the interest rate can certainly fool you if you let it. But if you do the math to figure out the cost of something, I'm telling you, you can make really good decisions when it comes to your money. All right? So now, when we're talking about before we get into leverage, all right, let's take a look at this. What if we took that $2,456 and a penny, we borrow that, and could we then apply it to this loan? Yes, we could. And if we did, would we be paid all the way down to line 12 in 1 month? And would we save nearly $11,000? Would we save $11,000 in interest? Yes, we would. And would we knock off 11 mortgage payments that we never have to make? We most certainly would. And our next mortgage payment for the next month would actually be on line 13. We jump from payment number 1 all the way down to payment number 13 in just 1 month. Now, those are our benefits. What does it cost? So if we take that $2,456 and a penny and pay it back to our neighbor in just 1 month, Okay. What if we were to, let's see, $2,456 and a penny, and we apply it to our loan, but we pay our neighbor back in 1 year. The neighbor wants 10% interest on the $2,456 and a penny. Wouldn't that be $245.60? You see, all we do is move the decimal from here to here when you're doing 10%. That's $245 in interest. Let me ask you, is it worth paying $245 in interest to your neighbor to borrow that money and then take that money and place it on your loan, knock off nearly a year of payments, and also save yourself $11,000 in interest? Isn't that amazing? All right. So now, like I said, we don't recommend that. This is just a thought experiment. It's important to know how much your money is worth. And we're going to be getting into that in just a few minutes. Now, again, we want to focus on interest cost, not interest rate. Now we're going to be talking a little bit about leverage, and this is very important here. Now, let's just say after 45 months on this loan, if we make the mortgage payment exactly like, oh, there's Carol Dial. How are you doing, Carol? She says, hi, Don. All right. We just met Carol the other day, and she is so excited about saving interest and paying off mortgages and reducing her debt. I'm telling you, it is amazing what people can find out once they start looking. All right. So, yes. Hi there, Carol. But so anyway, so what we're doing here, folks, is if we take a look at paying the mortgage exactly like the bank wants us to. What if we, after 45 months, if we take a look at the cumulative principal, we will actually pay this mortgage down by $10,019.53. Right there. Now, we can also see that the bank wants to charge us for that privilege $43,939.97. Let me ask you, folks. Should it cost $43,939 just to pay your mortgage down by $10,000? When you add it together, that is a tremendous amount. Look at that. $10,000 we get. The bank gets $43,939.97. That is a $53,000 payout for a $10,000 benefit. Folks, how fair is that? Is that how we want to spend our money? Absolutely not. So, let's take a look at how we can pay our mortgage down by $10,000 for less than $5,000 in interest. If there was a way for you to be able to do that, pay down your loan, pay down your mortgage for less than $5,000 interest instead of $43,000 interest, would you want to know how? Let's go over that. So here is an example. This is John and Rebecca Jones, and every situation is different. But in this case, we're using round numbers just to make it simple. Now, in this case, we have $2,000 left over after all the bills are paid. But you can have $1 left over, or you could have $21,000 left over. The important information is that leverage is how small amounts of money can cancel huge amounts of interest. So in this case, we're working on having $2,000 left over. Watch this. So here's our example. After all the bills are paid, there's an average of $2,000 left over. So what are we going to do with that money? Okay, we're going to put it away into a savings account and build an emergency fund. All right, $2,000 in our emergency fund. We'll put it over there. Now, that's after we put money away for our retirement. That's after we pay the regular bills. That's after we pay the minimums on all of our loans. And that's after we set aside money for having some fun. Okay, we've got to have an entertainment budget. We've got to have a lifestyle budget. We got to have that part of what we do. And then when we take care of all of those things, we take the rest of the money that's left over and let's put it in our emergency fund. So we've got $2,000 going there. Let's say after about 10 months, we have about $20,000 in the emergency fund because we're putting away $2,000. Okay. So here's my question. Can we now apply $10,000 out of our emergency fund to mortgage principal? Well, yeah, we can. Let's take money out of that. So if we start at payment number 1, and if we apply $10,000 at one time to this loan, wouldn't we be paid down to line 45 in just 1 month with that $10,000 from our savings account that we're making, what, 0.25% on? And when we do, will we not save all the interest between line 2 and line 44, coming to $42,988.83? Of course, we have to subtract the $1,000 from line 1. So we're saving $41,000. Isn't that fantastic? With taking $10,000 out of the savings account and applying it to the mortgage. Our next payment then would be on line 46 in this example. Now, let's take a look at here. Let's take a look at what's happening. Our total savings, $41,988.33 for taking $10,000 out of a savings account that's making us, what, 0.25%? Man, that is a fantastic trade, isn't it? So, after the $10,000 is applied to principal, how long would it take to return that money to the bank at $2,000 per month? Remember, we have $2,000 left over, and we just took $10,000 out of our emergency fund, but we still have $10,000 left for emergencies. So let's build up our $10,000 again. How long would it take? You got it. At $2,000 a month, it would take 5 months. Now let's figure the cost to save $41,988.33. Remember, we always have to figure the cost. When you make a financial move, you want to be able to figure the cost of that financial move to make sure it was a good move. So, how much interest is the bank paying us on our accounts right now for savings? Now, we know it's, for most of us, it's less than 1%. But for expediency's sake, just to keep the number simple, let's just say the bank is paying us 1% interest. Okay? So that's $10,000 times 1% interest, because if we keep it in the bank, we make $100 a year. 1%, $10,000 a year. So we would make $100, all right, in that year. So we're going to take that $100 and divide that by 12. That comes to $8.33 a month. So every month, that $10,000 is not sitting in our bank. We're losing $8.33. So we actually did without that money for 5 months, because after 5 months we put it back. So 5 times $8.33 is a total interest cost of $41.65. That's what we lost by taking $10,000 out of the bank at 1%. We lost $41.65. So let's go over this thing again. We took $10,000 out of the bank. We applied it to our mortgage. We knocked off 45 payments. And when we knocked off 45 payments, we eliminated $41,988.83 in interest that we never have to pay. We eliminated 44 payments that we never have to make for a total cost of $41.65. Folks, I got to ask you, is it worth paying $41.65, losing that money so that we can eliminate $41,988.83 in interest? You better know that it is. So we're going to pick up from here next week, where we're going to go into liquidity. But I promised you something. I promised you, if you showed up today, that we would actually go over how people with perfect credit pay 100 to 400% interest, and they don't even realize it. So I'm going to put on the screen here. Get out of this screen. All right, and pull up. All right, well, I guess this is time for a commercial. Remember, get the book. Oh, if you go to, I forgot to tell you, folks, if you haven't bought the book yet, or even if you have, all right, go to the P.I.L.L Method website. Let me pull that up. Let me pull up the website. Here's what you want to do, because we just put this up, all right? Here, there we go. All right. Putting that up there. Now I want to put it on a different one. So we're going to go here to Mr. Brett Whistle. And then we're going to go to the website. Okay, here comes the P.I.L.L Method website, all right? And so now with the, if you scroll down on the website, you will see a link to get the book, all right? So now if you once you purchase the book, you can get a free bonus. So we'll click on that link and see what happens. All right, it comes to this page, a better way to eliminate debt. And step 1 is buy the book. So click here, takes you to Amazon, buy the book. Once you bought the book, then come back here. You can read a few testimonials, all right? But then to claim your bonus, all you have to do is put in your first name and your email address and what is your Amazon order number. Put that in there and you can download the bonus. It is the P.I.L.L Method's Family Planner Excel spreadsheet. The P.I.L.L Method's Family Planner Excel spreadsheet, and you can have it for free after purchasing the P.I.L.L Method book. So make sure you get it. It's a better way to eliminate debt. It's the only book like it in the entire world. I think you're going to like it. So there it is, right there. All right, so let's get back into our lesson. We're going to go back to here. Now, I'm going to, this is, let's see, we need to make these numbers just a little bit bigger. There we go. And move our camera in a little. There we go, so we can see things better. All right. So let's go to work. All right. So we have, let's say we have a $250,000 mortgage. All right. And the $250,000 mortgage started out at 5%. And, we, Americans really don't have 30-year loans. What Americans have is a string of 5 to 7 year loans until we die, because we refinance. So here's what it looks like. So we're going to take a look at what it means to have a $250,000 mortgage at 5% for 30 years. Your payment is now $1,342.05. That's just the principal and interest. It does not include taxes and insurance. So here's what's interesting. For $250,000 borrowed, your bank at 5% wants $233,138. Wow, in interest for a total repayment of $483,138. Folks, this is the true cost of your home. You've got to include the interest cost. And I know most of us are going to pay that because 90% of the people you know will never pay off a mortgage. Therefore, they're going to pay every dime of that money and then some, especially if they refinance. So we have $250,000. We have a $250,000 home that we're going to pay $483,000 for. Will we ever recoup our costs? You know, I do seminars all the time, and one of the questions that I ask is if you buy a home for $300,000 and then 5 years later you sell it for $400,000, how much money did you make? Everybody in the room says $100,000. Not true, because what we forgot was to figure out how much interest we paid during that time and then subtract it from how much money we sold the house for. So we have to subtract from that $100,000 the amount of interest that we paid. That will tell us how much money we actually made. So now, every 5 to 7 years, we get to refinance. So in this case, let's just say we're in this loan where $300 goes to principal, $1,041.67 goes to interest. In the very first year on this loan, we pay it down by $3,688.34, but the bank wants $12,416.26 in interest to do that. There you go. There are the numbers. Okay? $12,416.26 to do that. And here is our, there we go. We're good. There it is. Now we can see our numbers and our principal balance. There it is. Okay? So now, after about 5 to 7 years, we tend to refinance. So let's go down to 60 months. Let's take a look at where we are. In 60 months, we actually pay this loan down by $20,000, and we pay $60,000 in interest. Folks, in 5 years, we've already spent over $80,000, and most people are totally unaware of that. Now, if we go to 6 years and 7 years, here is $30,000 in principal pay down and $82,000 in interest. Folks, that is, wow, $111,600. $111,000 paid out in 84 months, and now it's time to refinance. So we're at we've paid it down to $219,000, and so we're going to refinance because we're going to get a lower amount. Okay, so interest rate. So we were at 5. So let's say we can get it down to 3.8. Wow, we're at 5, and we can get it down to 3.8. So let's go over here. We're going to put that amount. Oop, there's the book again. Got to get over here and pull up another Mr. Whistle here. Move that over. There we go. And so now here's how much we have there. We're going to paste that. Okay, got to take out the comma. Boom. All right. And now we're at 3.8. Okay. Now this particular refinance cost John and Rebecca Jones $6,000. But here's what they're looking at. Here's their new payment. Okay? We're at $1,024.47. So let's go back and take a look at where we were. Okay, our first payment was $1,342.05. Now our new payment is $1,024.47. We're doing pretty good. But remember, we had to pay $6,000 to accomplish this. So now we're at not 219,000. We're at 225,000 now because we had to put $6,000 on top of that. And what we're doing is that we're telling the bank says, well, don't worry about that, because if we roll that into the mortgage, it's only going to raise your mortgage payment by what, $2, $3, $4. No, don't worry about it. Okay, so we don't. We add it in there and we're good. But we got that fantastic 3.8 interest rate when, in fact, we were paying 5% before. But don't forget, we've already paid $80,000 in interest. So let's go down here and take a look at paying back this loan. Uh-oh, got it. I forgot to click here. We need to do that. We're going to take out that and recalculate. There we go. All right, now here are our payments. $337.19 going to principal, $715 going to interest. See, our interest payments are a lot smaller now, okay? We should feel really good about that. So let's move this here so we can see it a little better. All right, so now, remember, we have $5,000 that we put on top of this loan because we rolled in the fee. So we have to pay back the $5,000 first before we get back down to our $219,000 plus, okay? So let's take a look at our cumulative principal, and we start making our payments, and in the first 3 months, we pay back $1,000 of the $5,000 fee. And if we look immediately to the right, we've already paid $2,000 interest on a $5,000 loan. After 8 months, we paid back just the $5,000. I'm sorry, the $6,000 in costs. We paid it down by what, $2,700? It already cost us $5,600 in interest. After the first year, we're still trying to pay back the $6,000 in fees that we rolled into the loan. In 1 year, we haven't paid a dime towards the mortgage. In 1 year, we're still trying to pay back the $6,000 in closing costs for the refinance. Now, take a look at how much interest we've paid so far. $8,511.57. By the time we've paid back $6,000, folks, is 18 months later. $6,000 we've paid back. And let's see here. There we are. $6,000 we've paid back in 18 months. Now we can start paying on the mortgage again. But look at the amount of interest that we've paid. Wow. $12,708.02. So let's break it down this way. After 18 months, we finally pay back the $6,000. But when you borrow $1 from someone and you pay them back $2, the dollar that you borrow and then the dollar in interest, isn't that 100% interest? So if we borrowed $6,000 and pay back $6,000 in interest, isn't that 100%? But if we borrow $6,000 and then add another $6,000 in interest to the first $6,000 in interest, isn't that 200% interest? Folks, let me ask you, is there any other way? Is there any way that I could talk you into borrowing $6,000 for 18 months and paying $12,708.02 in interest on that loan? Is there any other way I could talk you into that? People who refinance do this routinely, and no one ever points it out until right now. We're giving this content away for free. We want you to have it. We're going to be exposing all sorts of things that are going on in the banking industry. And folks, I'm not anti-bank. I love the bank. I've got 4 mortgages. But what I want you to know is this. You do not have to continue to pay interest like this. You can cut your interest costs by 75%. Pay off all of your loans in 7 to 9 years on average. Some are a little more, some are a little less, but on average, that's not just the mortgage, that's your student loans. That's the mortgage, that's your credit cards and your car loans, everything. Because we are focusing on how to pay back the loan in the most efficient manner. If you go to my website, you will find a video there, the Opportunity Cost Calculator. You want to watch that video, all right? So we're going to go back to the website. We're going to go to the videos, and I'm going to show you which video it is that does all of the math, that tells you exactly what to do and when to do it. Okay, so we're in the videos now, and let's scroll down a little bit. Oh, we're too far. There we go. There it is. Let's start it from the beginning. Boom. Okay, it's this video here. Okay, if you look at it in the list, it's right here. It's this one. Okay, the P.I.L.L Method's Opportunity Cost Calculator. And this is what it looks like. Get this out of the way. Boom. All right. The P.I.L.L Method Opportunity Cost Calculator. And it starts out like this. So this is the program that does all of the math for us so that we can then save a tremendous amount of interest. Folks, that's just one thing that we talked about. I've got a few minutes left before the top of the hour. I want to talk about also what would have happened if this was a different type of loan. All right. So I had this situation happen to us not too long ago. And a lady had $300,000, all right, for a mortgage at, I think this was a while ago, so 3.5%. Okay. And there was some equity in the house. So there it is. We'll scroll in there, all right? Make this maybe a little bigger. Bam, like that. All right? So we got $300,000 at 3.5%, 360 months. So what she did was she had $60,000 in other debt. Okay? High interest debt. You know how we can consolidate debt? And when we have this other high interest debt, 10%, 11 to 15, 17% credit cards, personal loans, that sort of thing. Maybe some student loans to pay off. So now when you're paying interest on those loans, it is not tax deductible. But for some clients, some of their mortgage interest is tax deductible depending on the your tax bracket and the new tax laws. So you want to refer to your your tax accountant on this and see how much of your interest is tax deductible. But for some, it is tax deductible. So what they're thinking is, this $60,000 I have in other debt, none of this interest is tax deductible, and I've got all of these payments. And so what I want to do is consolidate and put it into my mortgage at 3.5%. That will save me a tremendous amount of money. So we're gonna do a new refinance, which is so we're going to refinance. We're going to roll in. We're going to cash out $60,000 of our equity to pay off this high interest loan. So we're going to put in that $6,000, and then we're going to put in another $6,000 for the closing costs. Okay, so now we're at $366,000 for 360 months, and this is what happens when people roll in that $60,000 into their mortgage at 3.5%. Now we have a payment here of $1,643.50, which is comfortable. That's just the principal and interest. We tack on the taxes and insurance, and everybody's happy. And now we start saving, because now I don't have all of these payments. I've reduced the payments maybe by sometimes between $300 and $500 we're saving per month by consolidating, and we feel really good about it. But let's look at what happens when we start to count the cost, okay? Even at 3.5% for $366,000, we're still paying back over 30 years, $255,660 in interest. And folks, that is 61.656% of the money you borrowed. How in the world do we get from 3.5 to 61.656? That is crazy. Oh, you guys can't see it. Oh, there it is. Bam, right there. How about that? There it is. Okay, so 61.656%. That's what's happening. So now let's take a look at this whole thing. And what now we want to do is figure out what it costs, what it actually costs to roll in $60,000. Now remember, we're going to pay back the first $6,000 here. It takes 11 months. It's going to cost us $11,649.30. That's just to pay back the closing costs. Now, let's take a look at what it costs to pay back the entire $66,000 we rolled into the loan. First year, $7,000 we've paid back. Second year, we paid back $14,000. $21,000, $29,000. We're at 5 years, and we've only paid back $37,000, and we're at $60,000 in interest paid. All right, 5 years. This is 6 years. All right, we're at 7 years now. Okay. All right, we're at 7 years, and 8 years. There it is, $60,000. All right, 7 years, and 84, 85, 86, 87. There it is, 92 months. We're only at 63,000. We got to keep going till we pay back 66, right around here, 65,999.17. It takes 99 months to pay this back, and $96,000 in interest. Folks, that's what happens when we choose to roll in that debt and we think we're getting it at 3.5%. But if we take that $65,000, we've already paid back $65,000 in interest, and another 30-some thousand. That would make it around, I'm just kind of rounding things off, but we've just taken a situation where we've rolled in 15% interest loans into our mortgage, so now that we can pay 150%. We paid $65,000, we paid $96,000 in interest to do that, and it took us 99 months to do it. 99 months. Wow. Has anybody ever pointed this out to you before? Only at the P.I.L.L method do we look at the total cost of what it means to do banking in America, and we're going to show you how not to do this. We're going to give you the tools. We're going to give you the education. We're going to show you exactly what we need to do to make sure that this doesn't happen to you. Please, please, please go ahead. You want to get my book right away. All right? There it is. Get the Pill Method book. Get the free gift. Do whatever you have to do. Read the book. Get a free analysis done. You can get a free savings report so that you can know the month, day, and year you could be debt free. Once we do that, then we can show you how much interest you can save, how much interest you've already paid, how much interest the bank still wants from you, and how much interest you will not have to pay the bank. This is amazing information, and this is the only book in the world that breaks down how all of this works. So, folks, I want to thank you for joining us for episode 2, and we're going to get back with you next week for episode 3, and we have some fantastic information for you in episode 3. We're actually going to talk about student loans next week. So if you have student loans or know someone who has student loans, you want to make sure that they're on the broadcast next week because they don't want to miss it. Thank you for joining us. Thank you for hanging out with us for the last few minutes, last 50 minutes or so. But I'm telling you, this is going to be great. Thank you so much. I'm looking forward to seeing you next week. Get the book and get your free gift. And if you choose, listen, get a free savings report. Know the month and year you can be debt free, how much interest you can save, and we'll also talk to you about how to take those savings and turn them into fantastic wealth. This is Don Daniel with the Pill Method, where we are the cure for the common debt and the prescription for building uncommon wealth. See you next week.